Leverage is one of the most misunderstood concepts in trading. On the surface, it promises the ability to amplify profits, to take a small amount of capital and turn it into something much larger. It's tempting, almost intoxicating. I remember early in my career feeling a rush at the thought of controlling a position 10 or 20 times larger than my account. It seemed like an opportunity to accelerate success, to reach milestones faster than I could ever imagine. But as with most things in trading, there is a shadow side, a flip side of potential that can turn exhilaration into devastation if not handled wisely. At its core, leverage is borrowed money. It allows you to take positions larger than your account balance would normally permit. A leverage ratio of 10 to 1 means that every dollar of your own money can control $10 in the market. A ratio of 100 to 1 or even 500 to 1, which some brokers offer in currency markets, can make you feel like a financial magician, conjuring large positions out of almost nothing. But that same magic has a cost. When markets move against you, losses are magnified in exactly the same proportion. That's why leverage is often referred to as a double-edged sword. The psychological impact of leverage cannot be overstated. When you are trading a large, leveraged position, every tick in the market feels like a seismic event. You are not just risking capital, you are risking your emotional equilibrium. A small adverse move can trigger a cascade of stress and panic, clouding judgment and pushing traders toward irrational decisions. Many traders who fall into the trap of high leverage describe it as a roller coaster that is thrilling in the short term but terrifying when it goes against them. That stress can lead to chasing losses, abandoning strategies, or holding on to positions far too long in the hope of a reversal that may never come. The risks of high leverage extend beyond emotions. There are tangible financial costs, too. Leveraged positions often come with interest on the borrowed funds, which can erode profits if a trade lasts for an extended period. They also carry liquidity risks. Closing a large leveraged position in a fast-moving market can be challenging, sometimes impossible at the desired price, leaving traders exposed to sudden swings. And then there is the ever-present risk of a margin call, where the broker demands additional funds to cover potential losses. If you cannot meet that demand, your positions are liquidated, sometimes at catastrophic levels. Yet, despite these risks, leverage is not inherently bad. When used wisely, it is a tool that can enhance trading performance. The key is understanding your risk tolerance and having a disciplined framework to manage it. Successful traders approach leverage like a scalpel, not a sledgehammer. They calculate exactly how much risk they are willing to accept, they set strict stop-loss orders, and they ensure that no single position can jeopardize their overall account. Let me share a story. John, a currency trader I once worked with, started with a $10,000 account. He was drawn to a broker offering 100:1 leverage. With just $10,000, he could control positions worth $1 million. At first, it seemed like a dream. He doubled his capital in a matter of weeks, and the thrill of those gains reinforced his belief in high leverage trading. But the markets are never static, and his luck would soon be tested. A sudden geopolitical event caused the euro to decline sharply against the dollar. John's large leveraged position turned against him almost immediately. Within hours, he faced a margin call. Unable to provide the additional funds required, his broker closed his positions, and his $10,000 account was nearly wiped out. That experience was devastating. The psychological impact was as significant as the financial loss. John realized that his problem was not the market, but his own approach. He had underestimated the power of leverage, failed to respect the risk, and ignored the fundamental principle that protecting your capital comes first. Recovering from that experience, John rebuilt his approach. He reduced his leverage to 10:1, a far more manageable level, and implemented strict risk management rules. He diversified his trades, ensuring that no single position could threaten his entire account. He committed to continuous learning, analyzing market trends, economic indicators, and geopolitical events to make informed decisions. Slowly, methodically, he began trading again, this time with a focus on consistency rather than rapid gains. The profits were smaller, but they were sustainable, and more importantly, he avoided the catastrophic losses that had nearly ended his trading journey. Leverage, then, is not a shortcut to riches. It is a tool that requires respect, discipline, and careful calculation. Used improperly, it can destroy accounts and confidence. Used wisely, it can allow a trader to amplify returns without compromising long-term sustainability. The lesson is clear: treat leverage as a calculated extension of your capital, not as a magic wand. Understand your limits, set your stops, diversify your positions, and maintain a vigilant awareness of market conditions. Over time, these practices transform leverage from a dangerous weapon into a strategic advantage. Remember, every trader will encounter moments where the temptation to increase leverage is strong. The allure of doubling, tripling, or quadrupling an account in days or weeks is powerful. But the markets are designed to test discipline and patience. Leverage exposes you to that test more sharply than almost any other factor. By committing to a measured, disciplined approach, traders can harness its benefits while protecting themselves from the emotional and financial shocks that come from overexposure. In essence, trading with leverage is an exercise in self-awareness, risk management, and long-term thinking. It demands respect for the market's unpredictability and a clear-eyed assessment of your own tolerance for risk. When approached thoughtfully, leverage can help you scale positions and profits in a way that aligns with your strategy. When approached recklessly, it can erase years of progress in hours. The choice is yours, and it is this choice, made consistently and wisely, that defines the trajectory of a trader's career.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.